Greetings, Jonathan Camarda. We thought we'd mix up the backgrounds a little bit for you, as well as show you some visuals here of where we see markets and some of the indicators that we're looking at, so you get a pretty good idea of what we're looking at. So the first thing that we're going to pull up on the screen for you here is going to be a chart of the S&P 500. So what you'll see here again, what we're looking at, with where the market is, a nice rebound from the April lows, with some of the tariffs are being pushed off as far as details and negotiations continuing. Certainly, some of that uncertainty has kind of cleared. Still a lot to be accomplished. I won't get into the granularity of that, except for the fact that the markets, have responded pretty positively. So one of the things that we really compare what's happened in the past, like during 2022. Totally different macro backdrop, right? You had the Fed that was raising rates, and you had the inflation fears and as such there. But the one thing when we looked at the initial drop of the market there, and then that initial rebound, right, that vicious rebound, stopped at a pretty significant level there in 22, and then resided rather to the downside. And this time around, again, the same first move back to the upside has broken through a pretty important level there, and what they call Fibonacci ratios, and I'll leave that there for folks that don't want to drown in the quantities. So that is pretty interesting to look at. And so you'll notice in a lot of your strategies, and within the sleeves, when you look at your accounts there, on Orion, that strategies like your global macros, your velocity raptors, and your all stars, which got pretty defensive, some more than others, especially all stars, as we started to broach some pretty significant levels, right, into early April there, started to again accumulate risk assets when things started to rebound. Some of the strategies like opportunistic growth and income, which is more longer term, a lot of taxable accounts, which can go to cash if we hit extreme bear market conditions, like in 22 it occurred. Did not this time. That stayed fully invested and did very well on that rebound. Strategies like your macro momentum, got more defensive as the market broke through certain levels, and is pretty balanced with some hedges there with fixed income and alternatives to go along with some of the equity exposure there. A lot more defensive than it was. Sector momentum, had gone partial and started to hedge into the downturn, and recently just got fully employed. So many strategies that are moving at different velocities, if you will, and different sensitivities, as far as to respond to what's going on from a macro standpoint. When we start to look at what we're seeing again, just kind of give you an idea. And since I'm showing you some of these visuals, I'll jump around a little bit. A lot of times I've memorized these a little easier on me now, but I can jump around a little bit and give you some pictures to go with the blathering, right? So we look at the National Association of Active Investment Managers. Again, not like most advisors out there. These are tactical managers. You can see exposure they have, back into the 70s from where they were really in the low 30s, 40s, and as such there, where some of our more conservative strategies certainly matched. Now, on some of our more active strategies, you folks are a lot more deployed to risk assets than this indicator is on the average in some of your more tactical, like I said, GMT, VRT, and All Stars. And of course, OGI stayed fully invested. So again, you'll have that exposure we've exceeded. So just use this kind of as a guardrail to kind of assess where the institutional money has been flowing. But you're definitely in some of your strategies certainly participating, with some of this upside move, depending on exactly how you're allocated within your overall risk schema. Now, one of the things that we look at as well, and it's so cool to be able to show you some of the visuals of this and how we make decisions as well. So here, when we start to look at various sectors, you can see the colors here. I don't know if it's big enough, but technologies is that fluorescent green. That has been the best performer over the last month. And if you notice in some of your strategies that are more active, right, we've been bouncing on technologies and as such in the rebound, because it has been the prettiest sector really since the rebound, with again discretionaries in red, your industrials there in orange and as such. Again, the laggards are your more defensive sectors, right? Your consumer staples and your utilities. Now, healthcare is down there. Healthcare has been miserable to begin with. A lot of backdrop to that. And of course, we have a very little exposure, had some individual stock exposure there, but not a large sector presence there, because that, again, it is one of the weaker sectors. Now, we look over the last 3 months, different story, right? Year to date, of course, with the downside early in the year, you had utilities and your consumer staples doing better, but that's why you have to constantly monitor, right? So when you look at your allocations, again, we're following those trends pretty closely from that standpoint. One of the things too is that we have not been fighting the trend. We've been sticking with our large caps. Value took over for a while, but now back to growth. You can see momentum, real attractive, obviously over the last year, of course. But if you look over the last month as well, you can see momentum and growth. Right, large cap growth, small cap surprisingly as well, with a nice rebound there. And so again, we're not fighting that trend. Now we look over the last 3 months. Again, momentum's taken over, but value was up there for a while to the recent rebound. So again, we pay attention to this in your various strategies and allocate accordingly, with a top-down viewpoint of that. We look at fixed income again, especially in your conservative strategies like active capital preservation, which is obviously shined like a jewel in this volatility. And again, you can see basic different various durations there on the treasuries, the 3 to 7, 7 to 10, 1 to 3 year treasuries that have held up well. And again, good guaranteed U.S. agency, as well as mortgage-backed securities as well, which you'll have a nice presence in your active capital preservation as well. It's done well. So on a fixed income standpoint, same thing, right? We want the highest pitched piano keys playing, for us in that situation. Now we start to look at the macro backdrop. Really, we're going to go over actually the currencies here. Again, a little easier. I don't have to memorize these. So play a little bit more of the meteorologist here, right? If you look at the map behind me. So if you look right here, the euro, again, which was just killing the dollar really for the first few months, has started to, again, pull back a little bit. The dollar is starting to get off the mat here, like the 100-pound weakling at the beach. Got some sand kicked in its face after owning the currency markets last year. The dollar has kind of come back a little bit. Again, USD in this case versus the Japanese yen, right? So in this situation, you want to look almost like a team sport, right? That was going down versus the yen, and you can see the rebound recently. That's how you would read it on these. So not to get too granular, except that the dollar has firmed up a little bit, and of course, we've certainly seen that with some of the resiliency there in markets responding to some of the lack of uncertainty, or uncertainty rather, just coming out of that, out of the air, coming out of the balloon on max uncertainty. We start to look at Treasury yields again. You can see the longer duration yields as you go through your 5 and 10 years, et cetera, into the mid to upper fours, with the short-term yields just under 4%. Now to show you, that's a normal yield curve, pretty much normal anyway, where longer-term rates are getting paid for going out in the yield curve. Just to take you back in time in the DeLorean, you go back to 23. You see that's reversed. That's inverted. Shorter term yields, right, were higher than longer term. And that's usually when expected economic growth is very, very doubtful. So again, now when we start to get to recession fears, they're out there, but they've been lowered with some of the uncertainty again coming out of the equation. But there are still some folks that give it a 35, 40% chance. We shall see. I mean, the numbers have been mixed. The labor numbers still seem pretty resilient. So that's generally the last leg to fall. We shall see if that holds up. When we talk about sell in May, go away, you have to be very careful just to have binary nursery rhymes to drive how you're running money. And of course, this May, certainly you didn't want to sell in the beginning of May. In fact, usually the smart money, if they're going to sell, it's late May into June. We shall see again if that's smart as well. But when we're looking at right now, obviously, as we move through May and here, you wouldn't want to just be selling with your eyes closed in that scenario. Now, as far as the Fed getting back to interest rates, looks like about 75 basis points is the projection really over the next 6 meetings that they're expecting, and that looks to be the case on where the smart money's looking, but we don't know until it occurs. Some factors that we look at right here: markets breaking through some significant levels, like we said earlier, of resistance, and again, all-time highs are still there. That could be a tough hurdle. So again, we do watch that as we apply our foot to the proverbial gas pedal, even on some of the aggressive strategies like GMT, which is about 90% equities, all stars in there as well, in the high 80s, 90s, Velocity Raptor in the low 80s, and then of course the opportunistic growth and income, which is in the high 90s. Some of the others are more variable, like your macro and sector, where it is more mid-range from that standpoint. And then you can see over the next 6 meetings in the other Fed where some of the probabilities are. Again, this is a crapshoot at this point, but just figured I'd mention that again, 75 basis points still looks to be what they're looking at. Now we look from a fixed income standpoint. You'll notice again here when we start to look at the duration of bonds, 2 year, right? Again, as we said, in the upper threes, just under four there, and then that 10 year is resting right in the mid fours. All right. So again, they vacillated a little bit with some of the uncertainty and of course the dollar, but we shall see where things go from there. With some of the backdrop, some of the weakness that is out there that has spurred some of the recession fears, but at this point, it's still to be seen. Now we start to look at the global picture, rounding out as a lot of your strategies like opportunistic growth and income, global macro, and as such have really started to diversify even early in the year before the tariff tantrum drop. You can see again, Europe has been pretty attractive, as well year to date, and as such there, even north of the border and as such as well. And then when we start to look across again, this is basically, I'm going to take you back about 3 months. You'll see again as we go globally, which is off to the right here. You can see a lot of green there versus again last 3 months, right? Even with the rebound, a lot of red domestically, the S&P, Nasdaq, et cetera. Over the last 3 months, you've had a lot more green in the emerging markets, and of course, your Europe, which we started to reside early in the year. Now, over the last month, of course, you can see that's changed, and with the upside, we've had outperformance in a lot of cases domestically because it was so oversold, and outperforming here on some of the international plays. But again, we shall see if that continues to be the pattern. And you can see a lot of your fixed income, of course, down. Not hard, but certainly down. The long end is down. Like your 20-year treasuries and such. And we'll get to that. We'll show you a chart of what we're looking at there. But of course, fixed income during a rebound, risk assets going up, right? Fixed income has dropped. Fixed income did better earlier in the year, of course, and you look over the last 3 months, where again pieces of fixed income, especially in the short end of the yield curve, are certainly helped out to offset some of the downside in equities. So, hoping some of these visuals actually help just smooth out the mosaic and how we actually look at it. It is a zero graph 3D chessboard as far as when we're making decisions and looking at things. So really wanted to add some perspective. I may do this going forward or maybe, just periodically, but did want to show you some of the things that we are looking at because there are a lot of factors that we do dive into. So one of the other things too, that when we start to look at as well, we start to look at, again, GDP growth and as such quarter on quarter. You can see that negative number there, right? A lot of talks about the U.S., and talk about recession. Again, it's a slight negative number there. And so we'll start to watch that. Again, a lot of positives generally when you look through Europe with some of the stimulation that they've had there and as such. So it bears watching. Now, GDP year to year still pretty resilient in the U.S. at about 2% and as such there. But when we start to look at debt to GDP, just to juxtapose position, for example, of us versus a Germany, you can see as Germany starts to stimulate their economy, they're working from a more leverage in a sense that they have less government debt per GDP there, which is something to look at as well. Now, jobless rates, again, U.S. still pretty quelled there, lower than some of a lot of European countries. Of course, Japan, even lower than us. But that's what we want to watch to see if that number goes up, right? That's when you start to worry about recession and the such there. So just to wrap it up, so that you folks probably hard to believe may have had too much of me already, but cup runneth over, and hopefully everyone's enjoying their spring, getting ready for vacation, graduations, and all of that. If you're traveling, stay safe. But so as far as strategies, the more aggressive strategies and tactical strategies have been definitely reacting to the upside, taking that risk on over the last several weeks, even in advance, especially a few of them in advance of some of the U.S.-China progress that we saw last weekend, and some of the other strategies where they're more defensive. So you have a balance. So when you have a sleeve, right, you imagine like a lifesavers, right, the different colors and as such, different exposure. So this way we can be pretty well balanced based upon what happens. Now, if you have any questions on your risk exposure, your appetite, and how that matches up, and the strategies that you have and the weightings of those strategies, certainly discuss that with your personal wealth advisor, as I do on a continued basis with my clients as well, to make sure that we have the weightings that are appropriate in your situation, both that you can fiscally take on and then also emotionally, right? Folks out there that like to see that green on the screen when it's going up, they can stomach a little bit more risk. Make sure you have enough weighting so that, again, you feel good about that, especially if liquidity is not an issue. That's the biggest thing, right? So until next time, again, this is Jonathan Camarda. Stay frosty, and we will stay eternally vigilant. Pleasure to serve.